Okay, so let's continue from where we left. We want to start a new topic. And our new topic is called ratio analysis. So as a company, why do you need ratios? Why do you need ratios? What are ratios for? That's what we want to find out. As a company, you can use ratios. Listen, as a company, you can use ratios to compare the performance of company A with maybe company B. Let us assume you are a company A and you want to know whether your performance was the same as company B, so which is maybe in the same industry. So you can use your ratios, or you can use ratio analysis to compare the performance of two firms, to compare performance of two different firms which are in the same industry. So that's one use of ratios, that ratios are used to compare the performance of different firms which are in the same industry. Then another ratio or another use of ratios that you as a company you might have or you might need is to compare the performance of the same company now, let's call it company A, but maybe over a period of time. You want to know in which year did we do better? Did we do better in the year 2010 or did we do better in the year 2011? So you compare the 2 years using ratios. You calculate the ratios from the first year, 2010, calculate the ratios of the second year, and from those ratios, you will be able to know which performance or how you performed as a company, So that's another reason why as a company, you need ratios. So those are the two uses of ratios. Number one, to compare the performance of different firms in the same industry. Number two, to compare the performance of a firm over a period of time. That is another use of ratios. So now we want to look at what are some of the ratios that you as a company, you can calculate, or a business. Which ratios can a business or a company calculate? Ratios can be classified. First, before we compute the ratios, normally ratios are classified into different categories. So the following are the classes of ratios. One, the classes of ratios. We have what we call liquidity ratios. This is classes of ratios. We have what we call liquidity ratios. Liquidity ratios. That's the first one. We have another class of ratios. These are liquidity ratios. We have another class of ratios. We call it activity stroke asset ratios. Another class of ratios is what we call profitability ratios. The third class of ratios is what we call profitability ratios. And the fourth class of ratios is what we call gearing ratios. And finally, we have what we call shareholders ratios. So these are the different classes of ratios. And under each class, there is some particular ratios that you can calculate. So those are the 5 classes of ratios that we normally classify ratios into. One is the liquidity ratios. Number 2 is the activity or what we call asset ratios. Number 3 is what we call profitability ratios. Number 4 is what we call gearing or gearing ratios, and finally, what we call shareholders ratios. So let me start with the first category of ratios. And that is the liquidity ratios. Now, if you as a company, you want to know whether your firm is able to pay its current liabilities. You want to know the ability of a firm to meet its current liabilities. You want to know whether your firm is able to pay all your current liabilities. So these ratios, which we are calling liquidity ratios, they measure the ability of a firm to repay its current liabilities. So these ratios measure the ability of a firm to repay current liabilities. That's what we are saying. So that is the purpose of these ratios, to measure the ability of a firm to repay its current liability. Are we as a firm able to repay our current liabilities or not? To know whether you're able to repay your current liabilities or not, then we are saying you calculate what we call the liquidity ratios. You calculate what we call the liquidity ratios. So we want to discuss which are these liquidity ratios. One of the liquidity ratios that a company can calculate is what we call a current ratio, is what we call current ratio. To get the current ratio, you take the current assets of your company, you divide that by what we call the current liabilities. You take the current assets of your company, you divide by the current liabilities. What are the current assets in your business? What are the current liabilities in your business? Find that ratio. That is what we are calling the current ratio, which is determined by taking current assets divided by current liabilities. Meaning, if your current assets are 500,000, let us assume, while your current liabilities are 100,000, that means if you calculate this, it shows you that our current assets are 5 times as much as our current liabilities. Current assets are 5 times as much as current liabilities. So we compare this and we get a ratio of what we call 5 to 1. That's how you express current ratios. 5 to 1 or 2 to 1, 1 to 2, 0.1 to 1, whatever it is. So we are saying that's how you express the current ratio, that you start with the ratio of the current assets to the current liabilities, 1. So you end up with 1 because we are comparing current assets to current liabilities. So our current assets are 5 times as much as current liabilities. That's how we calculate. Now, in a normal business, it is recommended that your current assets should be twice as much as your current liabilities. The current ratio, the standard or the recommended ratio is normally 2:1. The recommended ratio is 2:1, meaning your current assets should be twice as much as your current liabilities. But before we do that, first, tell me this. If the current assets of this firm are 500, while the current liabilities are 100,000, is this firm able to repay its current liabilities? Is this firm able to repay its current liabilities? The answer is yes. So we normally say, a point is here now, when you get a ratio which is greater than 1, any ratio greater than 1 means that the firm is able to repay its current liabilities. When you get a ratio which is greater than 1, then it means the firm is able to repay its current liabilities. What if our current assets were 200,000 while the current liabilities were 400,000? Will your firm be able to repay its current liabilities? Will your firm be able to repay its current liabilities? The answer is no, because we can see our current assets are half as much as current liabilities. So this will be given to us as a ratio, which is 0.5 to 1. Our current assets are half as much as current liabilities. So we express the ratio as 0.5 to 1. So the point is this: when you get a ratio which is less than 1, that means that the firm is unable to repay its current liabilities, So we are saying when it comes to current ratio, the ratio being a liquidity ratio, we have said it measures the ability of a firm to repay its current liabilities. The ability of a firm to repay its current liabilities, that ratio is what it is about. And we are saying the one ratio for it is what we call current ratio, where we are saying it's determined by taking current assets, you divide by current liabilities. You take current assets, you divide by current liabilities. And I've said any ratio greater than 1, any ratio greater than 1 means that the firm is able, any ratio greater than 1 means that the firm is able to repay its current liability. Any ratio greater than 1 means that the firm is able to repay its current liabilities. While any ratio less than 1 means that the firm is unable to repay its current liability. Then I've said the recommended, the standard ratio is 2:1. The recommended or the standard ratio is 2:1. So the question now is, now that this one gave me 5:1, is there any problem with this company? Is there any problem with that company? We are saying, one, of course, the firm is able to pay its current liabilities. There is no doubt about it. But the standard or the recommended ratio being that it's supposed to be 2:1, then when you get a ratio, get the point now, when you get a ratio which is greater than 2:1, then we say that this firm is holding too much funds. When you get a ratio which is greater than 2:1, then we say this firm is holding too much funds in current assets. They are holding too much funds. They are not supposed to hold much funds in current assets, no. So we are saying the problem is that when you get a ratio which is greater than 2:1, the firm is said to be holding too much funds in current assets. Those funds could be invested elsewhere. Maybe among the current assets, you have too much money in the bank, which is just lying there idle. And so we are saying that cash or whatever is making the current assets more, that money or that funds could be invested. Those funds could be invested elsewhere to generate profit for the business, So I am through now as far as this ratio is concerned, and that is what we are calling the current ratio. We are saying you get it by taking current assets, you divide by current liabilities. We have said the standard or the recommended ratio is 2:1. We have also said any ratio greater than 1 means the firm is able to pay its current liability. Any ratio less than 1 means that the firm is unable to pay its current liability. Like this one, the firm was unable to pay its current liability. And we have said always express the ratio 2:1, 2:1, 2, whatever to 1, whatever to 1, whatever to 1. That's what we are saying about the current ratio. Now, this ratio is also known as working capital ratio. Is also known as working capital ratio. So when they tell you to calculate working capital ratio, they are telling you to compare current assets with the current liabilities. So I'm through with one of the liquidity ratios. The second one is what we call this is number 1. Number 2, among the liquidity ratios is what we call the acid test ratio. So that's another liquidity ratio, acid test ratio. How do we determine that acid test ratio? We normally get it by taking the current assets. You take the current assets, you minus the stocks or the inventory, and you divide that by current liabilities. That's how we determine the current ratio. You take the current assets, you minus stocks, and you divide that by current liability. Now, the purpose why we minus stock is because we want to get the most liquid assets. We want to take among these current assets, which ones are the most liquid assets? Most liquid, that means you remove stocks, because stocks can take a bit of time before they are sold. But cash which is in the bank or cash in hand is already liquid. Money in the bank is already liquid. Debtors normally take you a shorter time to pay you. So among those others, apart from stocks, those are considered to be a bit liquid, more liquid. So you compare your more liquid assets, current assets, with the current liabilities. Remember, you know, current liabilities are those liabilities that should be paid within 1 year. Current liabilities are those liabilities that should be repaid within 1 year. But sometimes in a business, you may have some stocks in your business that may take you more than a year before you sell them. There are some stocks in a business that may take you more than a year before you sell them. So you cannot use them to compare with your ability to pay the liability within 1 year. Current liability being those liabilities that should be repaid within 1 year. Then we are saying, I want to know which liabilities, these liabilities that I'm supposed to pay within 1 year, am I still able? So when we are taking current assets and you minus the stock, that leaves you with the most liquid assets, which can easily be converted into cash. And so you compare those ones now with the current liabilities. So that's how we shall be calculating the ratio we are calling the acid test ratio. What we are saying, it should be determined by taking current assets minus the stocks. You divide that by current liabilities. The recommended ratio for this ratio is 1 to 1. The recommended ratio is 1 to 1. Meaning, once you take your current assets and you minus the stock, that figure which you remain with should be the same as your current liability, should be the same as your current liabilities. So that's how we shall be determining the acid test ratio. This ratio is also known as quick ratio, So I am through with the two of the liquidity ratios. Those are the two liquidity ratios that we shall be calculating whenever we are doing a question. And when the examiner tells you to calculate the liquidity ratios, you calculate the current ratio and you also calculate the acid test ratio, which we have said is also known as the quick ratio. We have said current ratio is also known as working capital ratio, is also known as working capital. For the current ratio, we have said the standard or the recommended is 2 to 1. And for the acid test ratio, we have said the recommended ratio is 1 to 1. There is 1 to 1. So I am through with the first class of ratios. Now I go to the second class of ratios, and that is what we call activity/asset ratios. So let's discuss those which we are calling activity/asset ratios. Now, these ratios, activity/asset ratios, these ratios measure the ability or the efficiency. They measure the management efficiency in utilizing their available resources. These ratios, I'm saying, which we are calling the activity/asset ratios, they measure the management's efficiency in utilizing the available resources. Of course, available resources are the assets that the company has. So how are we able to utilize those available resources? So to measure the ability of a firm to utilize the available resources, then we calculate what we call the activity or asset ratios, And one of the activity ratios we shall be calculating is what we call stock turnover. To get the stock turnover, we normally get it by taking, cost of sales. You take the cost of sales, you divide that by what we call the average stock. You divide that by the average stock. That's how we shall be calculating what we are calling, the stock turnover. You take the cost of sales, you divide that by average stock. Now, whatever answer you get, that answer should always be expressed in terms of times. Whatever answer you get, it should always be expressed in terms of times, 2 times, 5 times, and so on. This ratio tells you how many times, get the point, how many times are you able to turn your stocks into sales? How many times? That's the explanation of this ratio. How many times are you able to turn your stocks into sales? You as a company, how many times are you able to turn your stocks into sales? So if you get 10 times, 5 times, and so on. Of course, the point is here, the higher the number of times your company is able to turn their stocks into sales, the better the firm. The higher the ratio, the better the firm. The higher the ratio, the better the firm. Now, to get this average stock, we are dividing by average stock. To get the average stock, we shall be taking what we call the opening stock. We shall be getting the opening stock plus the closing stock, whatever it is, and you divide that by 2. That's how we shall be getting the average stock. That's how we shall be getting the average stock. That we get the average stock by taking the opening stock of the company plus the closing stock of that company. We divide that by 2. That will give you what we call the average stock. That will give you what we call the average stock. So I am through with the first of the activity ratios. I am through with one of the activity ratios, which we are calling the stock turnover. And we are saying these ratios, we are saying, tells us how many times your firm is able to turn your stocks into sales. And the higher the number of times, the better the firm. The higher the number of times, the better the firm. We now go to the second ratio. We now go to the second ratio on what we classify under activity ratios. Under activity ratios, that is number 2. The second ratio is what we call debtors collection period. Debtors collection period. Debtors collection period. Debtors collection period. Now, of course, you can call it trade receivables collection period because debtors are also known as trade receivables. So you can call it debtors collection period. Okay, now, this ratio, before I even continue to show you how to calculate it, this ratio tells you how many days your company takes to collect from debtors. How many days does it take to collect from your debtors? That's what the ratio implies. Debtors collection period. How many days it takes. Once goods are sold on credit, how many days does it take to collect from debtors? To get that amount, we shall be taking, what we call average debtors. Average debtors. You divide that by the average credit sales per day. The average credit sales per day. The average credit sales per day. That's generally how we get it. We are saying take the average debtors of the company, you divide that by the average credit sales per day. We are using credit sales. Why? Because they are the ones which bring about debtors. Cash sales don't bring about debtors, so you only use the credit sales. Meaning, this formula can be expressed as average debtors. Average debtors. You divide that by, to get the average, get the point here now, to get the average credit sales per day, you can take the credit sales for the year, you divide that by the number of days in a year. In most cases, we always assume a 365 day in a year. So you divide that by 365. Then this still can continue being expressed as average debtors. It will be average debtors. You divide that by, we are saying credit sales for the whole year, you divide that by 365. So you can see again, mathematically, this can be expressed as average debtors. Average debtors. You now multiply that by what? By 365. You multiply that by 365. You now divide that by credit sales. You divide that by credit sales. And we have said the answer you get, you should express it in terms of days. The answer you get should be expressed in terms of days. How many days does it take you to collect from debtors? Now, in an exam, you don't have to show the examiner all this calculation or this working in terms of the calculation of the debtors collection period. No, the formula that you can quote for him is this one. This is the last formula we are interested in, that we are saying to get the average, to get the data's collection period, we shall be taking average datas, multiply that by 365, you divide that by credit sales for the whole year. You divide by the credit sales for the whole year. But to arrive at this, I was saying normally you take the average datas, you divide that by the average credit sales per day, divide by the average credit sales per day. Then this denominator is the one I'm trying to show. How do you get it? You take the credit sales for the whole year, you divide by the number of days in a year, which we are assuming to be 365. Then this again, we are saying can be expressed this way, where you divide this by credit sales, divide by 365. Finally, we are saying this can become average datas, multiply that by 365, you divide that by credit sales, you divide that by credit sales. So when we shall be doing past papers, the formula we shall be quoting should be this one. The formula we shall be quoting should be the last one. That is how we shall be calculating the data's collection period. That is, we take the average datas, multiply that by 365, you divide that by credit sales, you divide that by 365. And I've said the answer you get should be expressed in terms of days. Now, to get average datas, of course, the examiner, in most questions, the examiner will give you two statements of financial position. One may be for the year 2010 and another one for the current year. I'm assuming the current year is 2011. So you get the data last year, get the data this year, get the average of those two. Get the average of those two, where you are given the statement of position last year and you're given the statement of financial position this year. Get the two data, add the two and divide by 2 to get the average data. But where the examiner has given you only one statement of financial position, assuming he gives you only the current year statement of financial position, then in that case we are saying use only the data for that year. Use data for that year. You just multiply now. You take data times 365. You divide that by credit sales. That's important, that when you are only given the closing data by the end of this year, use the data by the end of this year only. Use the data by end of this year only. You multiply that data by 365. You divide by credit sales. Okay. So I'm through with the first one. But before I leave it, let me ask you now, before we leave this one, let me ask you this question. Here are two companies. One, company A has its data collection period being 20 days, while company B has their data collection being 50 days. Which company would you say is better? Company A has a data collection period of 20 days, while company B has data collection period of 50 days. Which company is better? Of course, I hope you have concluded that company A is better. Why? Because it takes shorter time for them to collect cash. So we can conclude this way, because in your exams, you are normally given the results of two companies, then you are told to calculate some ratios, then you are told to compare those ratios and conclude which company is better. So we are now saying that company A takes 20 days to collect from debtors, while company B takes 50 days. We have said the shorter the period, the better the firm. The shorter the period, the better the firm. Why? Because this company is able to collect their cash earlier, and therefore they can utilize their cash elsewhere to generate profit. While this other company has another 30 days to collect their cash, you as company A, you have already received your cash and you're able to utilize it elsewhere to generate more profit, So we are concluding by saying the shorter the period, the better the firm. That is one reason why we are concluding the shorter the period, the better the firm. Reason number one is that you're able to collect your cash earlier and therefore you're able to utilize it elsewhere to generate profit. That's one reason why we are concluding the shorter the period, the better the firm. The second reason why we are concluding the shorter the period, the better the firm, is because the shorter the period, the less the chances. The shorter the period, the less the chances of bad debts arising. The longer you give your customers to pay you, the more likely it will be ending up being a bad debt. And so we are saying the shorter the period, the less the chances, or the lower the chances of bad debtors arising, as compared to the longer the period where the chances of bad debtors arising is high. So that's the second reason why we are concluding the shorter the period, the better the firm. The shorter the period, the better the firm. So that's all for that ratio. So we are through with the second ratio, which we are calling the debtors collection period. And we're saying to get debtors collection period, we shall be taking average debtors, multiply that by 365, you divide that by credit sales. You divide that by credit sales. So I go now to number 3 ratio. I now go to ratio number 3. And our third ratio is called, creditors collection period. Creditors collection period. Again, before you even give the formula, what does it tell you? What does it tell you? Creditors collection period. What does it tell you? It tells you how long it takes you as a company to pay your creditors. How long does it take you as a company to pay your creditors? Of course, to get it again, we shall be taking average creditors. We shall be getting it by taking average creditors. You divide that by what now? What shall we be dividing by? We shall be dividing that by what we are calling average. Again, we divide that by the average credit purchases per day. Average credit purchases per day. Again, we are using credit purchases because cash purchases don't give rise to creditors. No, it's only the credit purchases that give rise to creditors. This again can be expressed as average creditors. This can be expressed as average creditors. We divide that by, to get the average credit purchases, you can take credit purchases for the whole year. You take the credit purchases for the whole year, you divide that by 365. That again will give you the average credit purchases per day. That will give you the average credit purchases per day. Then once you get that this again can be expressed as average creditors. We have said you divide that by credit purchases. We divide that again by 365. This finally can be expressed as average creditors. We multiply that by average creditors. We multiply that by 365. We divide that by credit purchases. We divide that by credit purchases. So that's how we shall be calculating. Again, once you get that amount, whatever answer you get, that answer should be expressed in terms of days. That answer should be expressed in terms of days. And so it shows you how many days does it take? How many days does it take to pay your creditors? How many days does it take you as a company to pay creditors? Now, again, in the exam, you don't have to show all these calculations. What you just need to show as the final answer is this one. As the final answer is that one. That to get the creditors collection period, we shall be taking average creditors, multiply that by 365, you divide that by credit purchases. That's how we shall be determining the creditors collection period. Whatever answer you get, we have said you express it in terms of days. And this ratio, we have said, shows you how many days it takes you as a company to pay your creditors, how many days it takes you to pay your creditors. Now, tell me this, one company takes 20 days to pay their creditors, company B takes 50 days to pay their creditors. Which company is better? Company A takes 20 days to pay their creditors, while company B takes 50 days to pay their creditors. Which company is better? Of course, I hope you have concluded that company B is better. Now, why is it that now we are concluding the longer the period, the better the firm? So when it comes to creditors collection period, we are now saying the longer the period, the better the firm. The longer the period, the better the firm. Why are we concluding that now? That's what we want to talk about now. Why are we concluding that the longer the period, the better the firm? Okay, now, the reason is this company A, by the time they are paying their creditors, you as company B, you have another 30 days to pay, meaning that you as company B, you can utilize your cash elsewhere before the date of payment. You can utilize your cash somewhere to generate profit before the date of payment. That's one reason why we are concluding the longer the period, the better the firm. The reason is, we are saying, is because the longer the period, we are saying you as company B, or whichever the company, can utilize their cash elsewhere. They can utilize their cash elsewhere before the date of payment. That's one. The second reason why we are concluding company B is better is because the longer the period, that means the more time you have been given, you as a company, it means the more time you have been given, you as a company, to make arrangements for payment. So the longer the period, the better the firm, because you are given enough time to make arrangements for payment, Those are the two reasons why we are concluding company B is better. One, because they're able to utilize their cash elsewhere to generate profit before the date of payment. Two, the longer the period means they are given enough time to make arrangements for payment. So that's our ratio. Number 3, still under activity ratios, Now we go to ratio number 4, under activity or asset ratios. We go to ratio number 4, under activity, or what we are calling asset ratios. And our fourth ratio is called fixed assets turnover. That is the fourth ratio, fixed assets turnover. How do we get the fixed assets turnover? To get the fixed assets turnover, we shall be taking the sales of the business. Fixed assets turnover, you take the sales, you divide that by average fixed assets. Take the sales of the company, divide that by the average fixed assets. If the question gives you only one statement of financial position, you divide that by the fixed assets for that year. If you are given 2 statements of financial position, get the average at the fixed assets last year plus the fixed assets this year, get the average of those two. Now, this ratio, you take the sales, you divide by the fixed assets. Listen. So this ratio tells you as a company how much, listen, for every shilling that has been invested in the business as a fixed asset, for every shilling invested in the business as a fixed asset, how much is that 1 shilling able to generate as sales? For every shilling invested in the business, how much is it able to generate as sales? Okay, so let's say company A has a fixed assets turnover of 5, while company B has a fixed assets turnover of 8. Which company is better? Which company is better? Company A has their fixed assets turnover being 5, while company B has their fixed assets turnover being 8. So it means, therefore, for company A, for every shilling they have invested in their fixed assets, that 1 shilling in a fixed asset is able to generate 5 shillings as sales. While company B, for every shilling they have invested as a fixed asset, that 1 shilling is able to generate 8 shillings as sales. So which company is better? It's obvious company B is better. So we can conclude by saying, the higher the ratio, the better the firm. The higher the ratio, the better the firm. So that's another ratio we call fixed assets turnover. It shows you how much the company, or how much fixed assets, for every shilling invested in the business as a fixed asset, how much is it able to generate as sale? How much is able to generate as sales? Now we go to number 5. And the ratio number 5 is what we call total assets turnover. Total assets turnover. Total assets turnover. This one now, you should be able to give me the formula. Total assets turnover should be now what? It should be, again, you take the sales, you divide that by average total assets. Average total assets. Again, the implication is the same. For every shilling invested now as an asset, for every shilling your company has invested as an asset, how much is it able to generate as sales? How much is it able to generate as sales? That's how we shall be getting it. Okay? That's number 5. Number 6. Debtors turnover. Debtors turnover. Debtors turnover. What do you think should be the formula? What do you think should be the formula? Okay. This time, you don't just take the sales. Why? Because not all sales give rise to debtors. Only credit sales. I hope you are getting. So you take the credit sales, you divide that by average debtors. You divide that by average debtors. That's what we say. Again, if there are no debtors last year and debtors this year, as per the question, you're only given debtors for this year, use the closing debtors only. You just divide by debtors. You just divide by debtors. That's the ratio we call debtors turnover. Debtors turnover. That's number 5. Number 6. Number 7 is what we can call creditors turnover. Let me put it here. Creditors turnover. Creditors turnover. What do you think should be the case? Creditors turnover. Now again, for creditors turnover, you know what brings about creditors is not sales. What brings about creditors is purchases. And which kind of purchases? Only the cash purchase are the credit purchases. So you take credit purchases, you take the credit purchases, again you divide that by average creditors. You divide that by average creditors. You divide that by average creditors. That's how we shall be determining the average, the data creditors turnover. That's how we shall be determining the creditors turnover. Now we go to the next item. And I think I'm through with all the activity ratios. We said activity ratios are which kind of ratios? We said these are ratios that measure the management's efficiency in utilizing the available resources. We mentioned which ones were those. We started with the stock turnover, where we said, how do you get stock turnover? We said you take the cost of sales, you divide that by average stock. And whatever answer you get, we said you express it in terms of times. After we finished that, we went to the second ratio, which was called debtors collection period. Debtors collection period. Then we went to the third ratio, where we called it creditors collection period. Now we are in the fourth one, fixed assets turnover. Number 5, total assets turnover. Number 6, debtors turnover. Number 7, that is creditors turnover. So we are now through with the second class of ratios. I want to go to the third category of ratios. I want to go to the third category of ratios, and those are the ratios we call profitability ratios. Those are what we call profitability ratios. Profitability ratios. Some of the ratios under this class are common ratios, so one should be able to calculate them even by now. When I tell you to calculate for me what is gross profit margin, that is a simple ratio that one can calculate. Gross profit margin. So how do you get it? Gross profit margin. That's one of the profitability ratios. Of course, profitability ratios measures the profitability of a firm. That's all we can say, that these ratios measure the profitability of a firm, the profitability of a firm. And of course, you know, the higher the profitability, the better the firm. Of course, you know that the higher the profitability, the better the firm. But give me the formula for getting the gross profit margin. This is not a new ratio to you. We normally get it by taking the gross profit. You divide that by what? You divide that by sales times 100. You divide that by sales times 100. That's how you normally get gross profit margin. You take gross profit, you divide that by sales, you multiply that by 100. Of course, if one company A has a gross profit margin of 40%, while company B has a gross profit margin of 60%, of course, which company is better? Of course, company B is better. We have said the higher the ratio, the better the firm. In other words, the higher the profitability, the better the firm. So that's one of the profitability ratios. That's one of the profitability ratios. We now go to the second ratio. And the second profitability ratio is what we call markup. Markup. How do you get markup? That's not a new ratio to you. Again, markup. To get markup, you know, we normally take again gross profit. This time you divide by what? Gross profit, you divide by what? By the cost of sales. You divide that by cost of sales. Multiply that by 100. That's how we get again the markup. We can call it gross profit markup or just markup. We can either call it gross profit markup or markup. We are saying you get the gross profit, you divide that by the cost of sales times 100. That's how you determine markup. The other one is what we call, number 3, is what we call net profit margin. Net profit margin. Net profit margin, how do you get it? When you're told to calculate the net profit margin, to get the net profit margin, you take the net profit, you divide that by what? Net profit margin. You take the net profit, you divide by what? You divide that by the sales, again times 100. You divide that by the sales times 100. That's how we calculate the net profit margin. You take net profit, you divide that by sales times 100. Then we go to the next one, that is number 4 now, still under profitability, still under profitability. And our fourth ratio is what we call return. on capital employed. Return on capital employed. Return on capital employed. How shall we be getting it? To get return on capital employed, we shall be taking net profit. Net profit, you divide that by capital employed. You divide that by capital employed times 100 again. Of course, on the capital that you have invested in your business, what is the return? Normally, the return is the profit. The return is the profit that your company made. So you take the net profit, you divide that by capital employed. You divide that by capital employed. Now, if it is a company, this could be a question you're given an income statement of a sole trader. But if it's a company that you are given, so we are saying for companies, you get the return on capital employed, return on capital employed, we shall be getting it for companies. You get that net Okay, so let's continue. Let's continue from where we left. We have said we were discussing how to calculate. We were discussing how to calculate the return on capital employed. And I was saying this, that to get return on capital employed, you take the net profit, you divide that by the capital employed of that business. You divide that by the capital employed of the business. Take the net profit, divide that by capital employed of the business. Now, I was saying to get the return on capital employed for a company, we shall be taking the net profit before interest and taxes. That's the point I'm trying to explain. You divide that by capital employed. You divide that by capital employed. Now you multiply by 100. So that's how we shall be determining the return on capital employed for a company. For a sole trader, just take the net profit. If the question gives you an income statement of a sole trader, just take the net profit, divide that by the capital employed of that company, of that business, multiply by 100. But if it's a company, then we are saying take the net profit before what? Before you charge the interest and before you charge the taxes. Then whatever you get, that is what you now divide by the capital employed of that business. Now, the other question is, how do you determine the capital employed of a business? How do you determine the capital employed of a business? From the statement of financial position, how can you get the capital employed of the business? We normally get capital employed to be equals to take the fixed assets of that company plus all the current assets and you minus current liabilities. So you take the fixed assets of the company, you add the current assets, and you divide that by the current, the current liabilities. In other words, we can say, take the fixed assets of that company, you add what we call working capital. You know current assets minus current liabilities give you what we call working capital. So you can get the capital employed of that business. You can get the capital employed by taking the fixed assets plus current assets, you minus current liabilities. Alternatively, we are saying take the fixed assets plus the working capital of that business plus the working capital. You can also get the same capital employed by taking total equity of the company. You take the total equity, you add, you get the capital employed again, you can still get capital employed by taking the total equity, that includes share capital, share premium, revaluation reserve, general reserve, all forms of equity. Then you add any long-term liabilities, any long-term liabilities. This is just another way of getting the total equity. Why? Because this figure, we are getting fixed assets plus current assets minus current liability. That amount, which is the same as fixed assets plus working capital, normally represents one part of the statement of financial position. Then the second part is where you normally come and say financed by, where you normally show the total equities, all the capitals, and the long-term liabilities. So we are saying you can still get what we are calling capital employed by taking total equity plus total equity plus any long-term liabilities plus any long-term liabilities. So I am through on the profitability ratios. I'm now through with what we call profitability ratios. So I want to go to the third class of ratios now. I want to go to the next class of ratios. And the next class of ratios is what we call gearing ratios, So we are through with the profitability ratios. So let's now move on to what we are calling, gearing ratios. So what is gearing? That's what we want to determine. So gearing, let me explain. Gearing, before I do that first, let me ask you a question. You know, when a company wants to raise capital, they can decide to issue ordinary shares. They can decide to issue preference shares. They can decide to issue debentures. Now, when you look at, or they can have loans. When you look at these three sources of capital or finances, those three, they have one characteristic. What is that characteristic? Which is not a characteristic of the ordinary shares. If you know and if you can see, these three, the characteristics of these three sources of finances is that the owners of the finances normally get what we call a fixed return. They normally get a fixed return. If it's preference shares and the question has a 10% preference share capital, maybe worth 10 million, then every year, you as a company, you are supposed to pay your preference shareholders a dividend of 1 million. 10% of 10 million is 1 million. They get a fixed return. If your company has a 10% debenture worth again 10 million, every year you are supposed to pay debenture holders an interest of 1 million. So that means they have a fixed return. If your company has a 10% loan worth 10 million, then you are supposed to give the loan providers the interest again of 1 million. So they normally have a fixed return. But when you have financed your business from ordinary shares, then the ordinary shareholders normally are not guaranteed a fixed return. They are not guaranteed a fixed return. That one I know you know. Meaning, in 1 year, the ordinary shareholders may get more dividend. In another year, the ordinary shareholders may get no dividend at all. So their dividend keeps fluctuating. Their return keeps fluctuating. So let me assume, now listen, out of your total capital, which could be 100 million, or let's call it 200 million, your total capital, all these sources included. When you look at this amount, how much out of the 200 have the ordinaries provided amount, maybe that is they are provided maybe 150 million. Meaning the other class of finances, all these other three have financed 50 million. So gearing, now I'm defining the term gearing. Gearing is a method. By the way, before I define it, these three sources of capital, we shall be referring to them as fixed. We shall be referring to them as what we call fixed interest capital. Fixed interest capital. So all these three, we shall be classifying them as fixed interest capital. So let me just use one name for them, and we come and say, yeah, fixed interest capital. Fixed interest capital. Meaning the providers normally earn a fixed return. We have said it includes preference share capital, it includes debentures and loans. So now, gearing. The point is this: gearing is a method of comparing how much of the company's capital is provided by the ordinary shareholders and how much of the company's capital is provided by the fixed interest capital. At the point, how much of the company's capital is provided by the ordinary shareholders and how much of the company's capital is provided by the fixed interest capital providers. When you compare those two sources, what you are doing is you are calculating gearing. So gearing is a method of comparing or finding out how much of the company's capital is provided by the fixed interest capital and how much of the company's capital is provided by the equity capital. We can call this one also equity capital. Equity capital. So when I say equity, I am referring to things like ordinary shares, share premium, retained profit, revaluation reserve, general reserve. All those are things that normally belong to ordinary shareholders. Those are the things that belong to ordinary shareholders in a company. What is it? Ordinary shares, share premium, general reserve, revaluation reserve, and retained earnings. All those are what we call equities. All those are what we call equities. So in simple, we can say when you are calculating gearing, you are comparing how much of the company's capital is provided by the equity providers, and how much of the company's capital is provided by the fixed interest capital. That's what we refer to as gearing. How much of the company's capital is provided by the fixed interest capital and how much of the company's capital is provided by the equity providers. Now, if more than half of your company's capital is provided by the fixed interest capital, if more than half of your company's capital is provided by the fixed interest capital, then we say your company is highly geared. If more than half of your company's capital is provided by, that is what we are saying, more than half is provided by the fixed interest capital, then that company is said to be highly geared. If less than half of the company's capital, if less than half of the company's capital is provided by the fixed interest capital, less than half is provided by the fixed interest capital, then we say that company is lowly geared. That company is lowly geared. If exactly half of the company's capital is provided by the fixed interest capital, then we say that company is neutrally geared. Neutrally geared. That company is said to be neutrally geared. If we are saying if exactly half of your company's capital, if exactly half of your company's capital is provided by the fixed interest capital, then we say your company is neutrally geared. That's how we say. So gearing is a method of comparing how much of the company's capital is provided by the fixed interest capital and how much of the company's capital is provided by the equity capital. We have said what forms equity capital. You will add the share capital, add the amount of the share premium, add the amount of the retained profit in the statement of financial position, add all the general reserves, all those that belongs to ordinary shareholders, add them. To get the total amount of the fixed interest capital, take the amount of the loan, take the amount of the preference share capital, take the amount of the debentures. All those earn a fixed return, classify them as fixed interest capital. Then I've said, if more than half of the company's capital is provided by the fixed interest capital, the company is said to be highly geared. If less than half of the company's capital is provided by the fixed interest capital, then the company is said to be lowly geared. If exactly half of the company's capital is provided by the fixed interest capital, then the company is said to be neutrally geared. So how do you therefore calculate gearing? How do you calculate gearing? There are two formulas that one can use. One formula of calculating gearing that we shall be using. Gearing, one method of calculating gearing is that we shall be getting gearing by taking the fixed interest capital. Fixed interest capital, we take the fixed interest capital, we divide that by total capital. We divide that by total capital, multiply that by 100. Multiply that by 100. Total capital now includes both of them. Total capital now includes both total equity plus total fixed interest capital. That gives you total capital. So let us assume this scenario now. Our fixed interest capital is 50. Our equity capital is 150. So if I'm to use this, it will give me fixed interest of 50. I divide by total capital of 200. I multiply that by 100. What does it come to? What would be the level of gearing? That looks like 25%. I hope so. Is it 25%? That is 50 divided by 200. Yes, it's 25%. So tell me this, is that company lowly geared, high geared, or is it neutrally geared? Now, when you are using this formula, let me explain. When you are using this formula, no, before I talk about that, let me talk about the second formula. The second formula for calculating gearing, is that gearing is equals to fixed interest capital. Fixed interest capital, you divide that by fixed interest capital. Fixed interest capital you divide that by what we call equity capital, again times 100, again times 100. That's another formula you can use to calculate the level of gearing. So let me use this first again. I have said you take the total equity, total fixed equity, a fixed interest capital, that is 50 million, divide by equity capital. Divide by equity capital, that is 150, that is the equity, multiply by 100. So what is the ratio? What's the ratio? There I am getting a ratio of what? Let us divide 50 divide by 150. That looks like 33 and a third. 33 and a third %. Okay. Now, let me reverse so that I ask you a question I wanted to ask you. Let's now take that this is 50 million and now this is 150 million. I've changed that. Let us assume now equity provided only 50 million while fixed interest capital provided 150. So if you are to use this formula, you will take 150 divide by total capital, which is 50 plus 150, that is 200. I'll multiply that by 100. So what does it come to? What's the ratio there? I take 150, I divide by 200. That gives me a ratio of 75. Using the second formula for the same combination, that now I'm taking the equity still 50, fixed interest is 150, so I take the 150 million, I divide that by 50 million, I multiply that by 100. What does it come to? What does it come to? It gives you 150 divide by 50 times 100. That gives me a ratio of 300%. Hoping you're following. Same structure. This is the capital structure of the company. The company has a fixed interest capital of 150 and an equity of 50. When I use the first formula, which says fixed interest capital, I divide by total capital. I took the fixed interest 150, I divided by the total capital of 200, I multiply by 100, I get 75%. The same for capital structure, this one, but now using this formula, which says fixed interest capital divided by equity capital, I get 150, which is the fixed interest. I divide by the equity capital, I multiply by 100, I get the ratio of 300. Now, from already here, from already in this structure, you can see that more than half of the company's capital, is being provided by the fixed interest. So already, this company is highly geared already, because we say more than half of the company's capital being provided by the fixed interest capital, then that company is said to be highly geared. Now, my point before we come to the end is this, of that ratio or that gearing. When you're using this formula, anything more than 50% for this formula, you will say the company is highly geared. Anything more than 50%, you conclude, when you're using the first formula, anything more than 50%, you conclude the company is highly geared. Anything less than 50%, you conclude the company is lowly geared. That's what we are saying. And when you're using the first formula and you get exactly 50%, then the company is said to be neutrally geared. When you're using the second formula now, which we have said is the fixed interest capital divided by fixed interest capital divided by equity capital, this formula, when you are using it, anything more than 100%, you come and say the company is highly geared. Anything less than 100%, for the second formula, It means the company is lowly geared. Less than 100 means less than half of the company's capital is provided by. When you're using this formula and you get exactly 100%, the company is said to be neutrally geared, So the interpretation that we shall be giving will depend on which formula you are using. For the first formula, which is fixed interest capital divided by total capital, anything more than 50% means the company is highly geared. Anything less than 50, company is low geared. Exactly 50, company is neutrally geared. For the second formula, which is fixed interest capital divided by equity capital, anything more than 100%, company is highly geared. Like here, we are seeing the company, more of the capital is provided by the fixed interest. That is highly geared, more than 100. Anything less than 100, company is low geared. Anything less than exactly 100, the company is neutrally geared. The company is neutrally geared. That's the point we are trying to say. So for now, we can stop there. Next time, I'll finish. I'm not yet through with all the classes of ratios. Remember, we said there are 5 classes of ratios. The first one was the liquidity ratios. The second one was activity/asset ratios. The third one was profitability ratios. And the fourth one that we have finished now is gearing ratios. So next time, I'm going to discuss the shareholders ratios. Once I discuss the shareholders ratios, then from there we shall do a few past paper questions. We shall do a few of the past paper questions. So maybe for now, we can stop there. We pick it up from there next time. So let's stop there now. We pick it up from there next